Oh boy, aren't you in for a treat? Because we're looking at 3 quality dividend growth companies that have caught my attention because they all have exceptional returns on capital and are trading below their historical valuations. But first, the disclaimer. I am not a financial advisor. I am a blue-collar welder who is passionate about investing and on the cusp of becoming a net worth millionaire. So this is for educational purposes only, not investment advice. I'm sharing 3 companies with you that look quality to me based on the fundamentals that I focus on. I'm going to give you just enough to decide if these interest you and you want to spend some of your own time digging a little deeper. But first, a word about ROCE and why it might be right for you. If you watch the channel, you know I am pretty passionate about return on capital employed, or ROCE, or ROCE. Charles T. Munger said, if a company can earn 20% on capital over 20 years, you'll do well almost regardless of when you buy it. But if a company earns only 6% on capital, you'll struggle to beat 6% returns even if you buy it on the cheap. Now, I like ROCE instead of ROIC, ROIC, return on invested capital, because as I've learned from fund managers Pulak Prasad and Terry Smith, ROCE includes all capital, debt and equity, and uses pre-tax profits, giving you a complete picture of how management allocates capital. But ROIC, return on invested capital, only looks at operating capital and uses after-tax numbers, so ROCE shows you the full story. And all 3 stocks today have a ROCE of at least 20% or more, because a company that consistently earns high returns on capital can't help but watch its stock price go up over time. And if you jumped here from the timestamp, welcome to company number 1, which is Kinsale Capital, ticker KNSL. Kinsale specializes in excess and surplus insurance, which is the stuff regular insurers won't touch. Think drone companies, cannabis dispensaries, high-rise construction. Kinsale says yes when others say no. And they operate in one business segment, which is excess and surplus lines insurance. And they generate revenue in 2 main ways, which are premiums, when a company pays upfront for insurance coverage, and then investment income, which Kinsale invests those premiums, also known float, until claims need to be paid. But here's why they're quality, and one thing that just completely blew my mind about Kinsale and why I'm considering starting a position is that they have a combined ratio of 76.4%. You might think, Russ, why the hell do I care about that? Well, this means that for every dollar of premium that Kinsale collects, they pay out only 76.4 cents in claims and expenses. That means they're keeping 23.6 cents in pure underwriting profit, and that's before they invest a single dollar of that money. If you've read the Berkshire annual reports, you know about combined ratio, and that the industry average is 95 to 100%. And most insurers lose money or break even on underwriting and depend entirely on investment returns just to stay profitable. So I love that Kinsale is operating in a completely different league with a 76.4% combined ratio. And again, if you read the Berkshire annual letters, you know Warren would always touch on the combined ratio. Oh my God, look how excited I am about combined ratio. Warren would always be trying to get down to 100% or lower because 100% is break even. Kinsale is at 76.4. You see on the screen from fiscal.ai, which I recommend you checking that site out, they have a ROCE of 32%, and their current price to earnings of 18.62, which means you're paying $18.62 for every $1 of earnings, versus their historical median of 35.77, which is 48% below their median level. AlphaSpread.com calls them overvalued by 5% based on intrinsic value, but that intrinsic value model doesn't account for the fact that this business earns 32% on capital. And when you have that kind of capital efficiency, the stock price tends to follow over time. So what's the catch? Their growth has slowed as the insurance market has normalized and the California wildfires have spooked investors. But the combined ratio is still 76.4%. That quality has not changed. Just the market's mood has. And they control 1.1% of a $130+ billion-dollar market, which means they have a huge runway ahead. Now here we are on simplysafedividends.com, which, by the way, try it out free for 2 weeks. Just give them an email address. You don't even need a credit card. As of this recording, they have a current share price of $386 and a market cap of $8.82 billion. Since they started paying a dividend in the mid-teens, they've had very fast dividend growth, 13.4% 5-year CAGR, and they're currently paying 68 cents per share per year. But again, a lot of you income investors, I know, oh, the yield is so small. Well, this is going to be more of a total return investment. So for those of us in the wealth accumulation phase, this is a fantastic opportunity, I think. Their free cash flow payout ratio is an absurdly low 2%. And other than 2016, every year their free cash flow per share has been up and to the right. And check that out. On a bad year, their sales growth is 19%. The last 12 months could have been a bad year, 18%, but they should recover, which is probably why now looks like a really good time for a long-term buy and hold position to be started. And some years they have a sales growth in the mid to low 40s. Kinsale only has 23.3 million shares outstanding. The revenue coming in the door, you have to see growing revenue if you want to buy a growing company. And their revenue keeps growing substantially every year for the last few years. Margins are just all fantastic. I love the free cash flow margin. Remember, we'll get it out of the way. With free cash flow, you can pay a dividend, you can buy back shares, you can carry it as cash on the balance sheet. You can do things like mergers, acquisitions, reinvesting back into the business. It is the lifeblood of the business. Many people like to look at earnings per share, but the cash comes for your dividend from the free cash flow. It doesn't come from earnings per share. There's cash in my brokerage account when they pay the dividend, not earnings per share. So free cash flow margin of 54%, that means for every $1 coming in the door in those sales, 54% is making its way to free cash flow. Just a very healthy company. And their net debt is 0.01%, virtually nothing. And their interest coverage ratio, how many dollars of operating income does a company have to cover every $1 of interest on the debt? 59.5. $59.50 of operating income to easily cover every $1 of interest on the debt. Why is that important, Uncle Russ? Well, you legally have to pay the interest on the debt. You cannot default on debt payments or you will face bankruptcy. No company wants to do that, so there is no problem with the company's balance sheet. Our second company is Zoetis, ticker ZTS, which is the world's largest animal health company. They make medicines, vaccines, and diagnostic tools for pets and livestock. So think of it simply as animals need healthcare just like humans do, and Zoetis is the #1 provider globally. 68% of the money they make comes from companion animals, which is the growth engine. 31% is from livestock, and 1% from other services. Now, their flagship product is Simparica Trio, and it's prescribed for over 13 million dogs. And a lot of this revenue is recurring because pets need ongoing parasite prevention and chronic disease treatment. Great for your dogs, bad for the parasites. From what I can tell, Zoetis is largely recession resistant, mainly because pet owners view their pets as family. Zoetis has pricing power, limited generic competition, and 70+ years of expertise. Remember, they were spun out of Pfizer, and they have over 1,200 patents. Zoetis has a current 5-year average return on capital employed of 26.4%, and their current price to earnings of 21.56 is 44% below its historic median level of 38.27. And Alpha Spread says they are overvalued by 1%, so basically fair value. But again, a 26% ROCE tells you this business creates value over time. Now, if you're invested in Zoetis like I am, oh boy howdy, has it been quite the roller coaster ride down, because they lowered their full year sales forecast and reported slowing growth in its U.S. companion animal business, particularly in sales of its arthritis drug Librela, due to social media concerns about side effects that the company is saying will be cleared up from third-party testing. But again, 68% of their revenue comes from the growing pet market, which is projected to hit $500+ billion globally by 2030. On Simply Safe Dividends, we see that they do rate Zoetis with a dividend safety score of 74 safe, current dividend yield of 1.56%, so you income-hungry investors might be a little more happy at that, and a market cap of $54 billion, which makes them large cap, and Simply Safe thinks they could be undervalued. Full disclosure, as of this recording, I currently have 105 shares with a cost per share of $153, so I'm in it to win it. I'm on the roller coaster. We're coming back up. I feel it. 16.4%, I am down, but this is a long-term hold position for myself. So they have 11 straight years of dividend growth with a super fast-growing dividend, a 10-year CAGR of 20%, a 5-year CAGR of 21.4%, but their last dividend raise was a little bit light in December of 24. It was only 15.7%. And as of this recording, they are currently paying $2 per share per year. Based on their 5-year average price-to-earnings ratio, Simply Safe Dividends thinks they are way below. And the way that this works is Simply Safe Dividends takes the 5-year price-to-earnings ratio average looking back, and then they put a gray shaded area of 10% above that and 10% below to give it a range of where the overvalued and undervalued and fairly valued would be. So when it's above that gray shaded range, they're thinking you want to wait for the price to come down into that area. And if it's below, probably a good time to buy because it will eventually come back up. So right now, Zoetis is significantly below that area, making them undervalued according to Simply Safe Dividends. Zoetis' dividend yield of 1.6% is way above the historical 5-year average, and the price to earnings, as you know, is below. A very healthy free cash flow payout ratio of 39%. Free cash flow per share, some years are down, but they always recover and go higher. And the next 12 months is expected them to see another record free cash flow per share. But if you look at their earnings per share, it's a different story. Almost every single year, it's just stair-stepping up and to the right. Sales growth is usually mid-single digits. They consistently buy back shares, currently down to 447 million, and their sales every year up and to the right. Margins, all very healthy for Zoetis. Free cash flow margin, now you know what that means, 24%. And their operating margin keeps going up. Remember, that's their EBIT, their earnings before interest and taxes. 49% of their capital structure is debt, but that's been coming down. They've been paying down debt generally over the last 10 years and quite a bit, actually. Net debt to EBITDA. You know what Charlie Munger thinks of EBITDA? It's called bullshit earnings if you ask him. Earnings before interest, taxes, depreciation, and amortization, because depreciation and amortization are actual costs to the business. But if you look at this number, 1.20 over the next 12 months means it would take 1.2 years of EBITDA to knock out their net debt. And the interest coverage ratio, a very healthy 16.5, and it has been rising. We love to see a rising interest coverage ratio, so I am not too worried about Zoetis' balance sheet. Company number 3 is Automatic Data Processing, ticker ADP, which processes 1 in 6 paychecks in America. They handle the entire payroll process from calculating hours, withholding taxes, filing paperwork, and depositing that money. And they serve businesses anywhere from 5 employees to 50,000 plus. And once they start using ADP, switching is painful, which is why 90% of clients renew year after year after year. So how does ADP make money? Well, they charge anywhere from $4 to $25 per employee per pay period. But something you might not know about ADP is that between when they receive payment and when employees get paid, ADP holds over $30 billion in client funds, which is earning interest, and that's called float income, just like an insurance company. They also sell HR software, tax filing, and benefit services, and their 2024 revenue is $20.9 billion, and they serve 41 million workers globally. But what the market wants to know is, can AI replace payroll? Probably not soon, because while AI makes ADP more efficient, it doesn't replace that need for a trusted partner. And in fact, ADP says that they are using AI to strengthen their services. ADP earned Dividend King status in 2024, which, as most of you know, is 50 consecutive years of dividend increases. And that's because payroll is mission critical and recession resistant, because even in 2008 and 2020, companies still paid employees. Check out this return on capital employed. It is 51%, which is among the highest on any screener, and they have a current price to earnings of 25.3 versus the median of 29.7, so it's trading 15% below that historical average. Now, Alpha Spread thinks that they're overvalued by 5%, but again, when you're earning 50% returns on capital, you create value faster than most models predict. But again, a lot of the discount that's baked in is AI, the interest rates being reduced, which will reduce their float income, and slower hiring. But the core fundamentals are still there, like 90% retention, a 50-year dividend growth streak, and an absurdly high return on capital employed of 50%. Simply Safe Dividends gives ADP a safety score of 97, very safe, with a dividend yield of 2.65% and a mega cap market cap of $101 billion. So they are a dividend king with currently 51 years of dividend raises, a 10-year CAGR of 12%, which is just so solid from a king, and a last dividend raise of 10.4% in November of 2025. ADP is currently hitting you with $6.80 of dividends per share. Simply Safe thinks that they're undervalued with an expected price range of $287 on the low end to a high end of $351. Again, that dividend yield is pretty high, above the 5-year average of 2.03%, and the forward PE is below the 5-year average of 28.5. Now, they have a higher free cash flow payout ratio, but it's nothing too crazy because they've maintained that for quite some time, currently 59%, and they're projected to be at 53% over the next 12 months, which would be the lowest that it's been in the last 10 years. And that would be because they are expected to hit a record free cash flow per share of $12.70. Sales growth is usually in the mid-single digits. Total sales, again, this is what we love to see. You have to have your sales growing if you want a growing company, growing dividends. It's just a good, healthy thing to see sales consistently going up and to the right. And ADP slowly buys back shares. They're currently down to 408 million shares. Margins, all fantastic. 20% free cash flow margin and an operating margin of 26%. So it's nice to see that going up as well. And 25% of their capital structure is debt, which is pretty darn low. But their interest coverage ratio, check it out, has been coming down. Used to be almost $60 of operating income to cover every $1 of interest on the debt. Currently down to 12.1, but that is still phenomenal. And a lot of investors, I know Simply Safe says 8, they like to see an ICR of 8, but a lot of investors like to see 5, just so a company has some wiggle room in case they run into some volatility and choppiness with their income and profitability. So do you see the pattern here with the 3 companies? All 3 exceed 20% plus return on capital employed. Kinsale at 32%, Zoetis at 26%, and ADP at 51%. All 3 trade below their own historical PE. Kinsale 48% below, Zoetis 44% below, and ADP about 15% below. All 3 have decent payout ratios. I mean, Kinsale's is just ridiculous at 3%, Zoetis at 32%, and ADP at respectable and modest 60%. So all 3 have room for years of dividend growth, and they're different industries: insurance, animal health, and payroll. So these 3 have zero overlap. Just like Warren Buffett says, people don't want to get rich slowly, they want to get rich quick. These are the opposite of get rich quick companies. They are build wealth slowly companies. However, timing is unpredictable, and quality companies can stay undervalued for months or even years, but if the fundamentals persist and stay intact, then patience tends to be rewarded. And if you do want to see what this welder is buying and investing on, click the link below, follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. I think all three of these deserve your watch list, and let me know if you own any of them or are going to put them on your watch list. So do your own research, and any crazy thing can happen. Just like in this floating box next to my head, I share with you a Peter Lynch pick that turned out to be a $1.6 billion disaster, but I'm still buying it. So if you want to know why I'm buying this fraud of a company, click the floating video there and I'll tell you all about it.